Vertiv is a company that helps companies develop critical digital infrastructure, things like data centers optimized for AI. Vertiv's unique offerings, including uninterruptible power supply and liquid cooling solutions, are highly in demand right now, as these newer generation data centers optimized for AI require a lot more power and therefore require a lot more cooling solutions. In recent weeks, this company has been under question, not because of what's happening inside of the company itself, so to speak, but because of what's happened over the industry in the last 2 months. There's been developments suggesting that some of the largest digital infrastructure buyers, companies like Alphabet, Microsoft, and Amazon, are going to reduce their spending over the next few years. And that's created a pullback for every business that's related to that industry. And Vertiv is certainly right at the epicenter of that industry. So I've been getting a lot of questions because I've had Vertiv stock rated as a hold for some time now, several months at least. I've had this stock rated as a buy. And so viewers and subscribers are asking, what do I think about this company now? And so that's what I'll do in this video. I'll revisit this company, evaluate its revenue growth in recent quarters, look at the cash flow, the investor capital, returns on investor capital. I updated my discounted cash flow valuation model today for Vertiv, and I'll look at the price multiples and answer if I think the stock is a buy, hold, or a sell. Let's get started.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So looking at Vertiv's quarterly revenue growth, we see some solid numbers here. 26% revenue growth for the company in the most recent quarter. You've seen volatility up and down for the company's revenue, and management for the upcoming fiscal year in 2025 forecasted revenue to be approximately $9.2 billion, with adjusted earnings per share coming in around $3.55. That would be improvements from 2024, where the company reported revenue of $8 billion and adjusted earnings per share of $2.85. So the management team is forecasting over 10% revenue growth and over 10% earnings per share growth, closer to 30% earnings per share growth for Vertiv in 2025. But 2025 is not what investors are concerned about with Vertiv's market opportunity. Investors are more concerned about 2026 and beyond. Why do I say that? Well, we've already gotten the numbers from the largest customers in the data center segment for 2025. Amazon, Meta Platforms, Alphabet, and Microsoft have all indicated they're going to increase spending considerably in 2025. But we don't know what they're going to do in 2026 and beyond. And recent questions surround those spending plans. Those large tech companies are facing pressure from their investors who are asking them, why are you spending so much on these infrastructures for artificial intelligence? What are you seeing in response? Are you getting revenue growth in response to building these data centers? So they're under more pressure. And if they're under pressure, they're going to pull back their spending, and that's going to hurt companies like Vertiv, NVIDIA, Supermicro Computer, Dell Technologies, the whole ecosystem surrounding that data center AI boom that's been absolutely thriving in the last, I want to say 2 years or so, since the launch of ChatGPT in late 2022. That really unlocked this spending boom in that segment. So Vertiv's cash flow from operations to sales has been volatile, but trending upward at 16.5%. Let's say 5% they reported in 2021. It's more than tripled to 16.47%. This is a capital intensive business, although they are working on improving their service solutions that come with higher margins. They still have that infrastructure solution that is more lower margin business compared to the services side, as is the case with almost any business. The services side of any business is usually more profitable than all the other segments. The returns on investor capital are less volatile, and you still see an uptrend here for Vertiv at 10.39%. That's up from negative 10% in 2021. And I wouldn't be surprised if it keeps moving higher, because the company is going to, or management is forecasting, revenue growth of over $1 billion here in 2025, and adjusted earnings per share growth well above that in 2025. So as its earnings per share grows, so will the returns on investor capital, unless the company deploys a lot more capital in 2025, which doesn't look to be the case here. So I updated my discounted cash flow valuation model for Vertiv Holdings today, March 11th. And the biggest change was the free cash flows forecasted by Wall Street analysts between 2025 and 2029. The Wall Street analysts that are following the company lowered their forecast for the company's free cash flow. And this is undoubtedly a response to the lowered forecasts for spending from those large tech companies that I highlighted earlier. So that's trickled down to lower forecasts for Vertiv Holdings. And so I incorporated that into my discounted cash flow valuation model, and that lowered my intrinsic value per share calculation. I previously had Vertiv's discounted intrinsic value per share at around $100 per share, over $100 per share. And today's update lowered the intrinsic value to $85 per share. It's still above the current market price. And I would like to remind my viewers that this discounted cash flow is only one input into my overall framework for deciding whether or not a stock is a buy, hold, or a sell. Remember, I've written a whole book on my framework, the 6-step investment framework. And valuation is only one step in my framework. And the discounted cash flow valuation is only one component of valuation. It's not the only thing I look at in valuation. So sometimes I get my viewers place too much weight on my intrinsic value per share calculations. So I'd like to zoom out a little bit and place it into greater context for you. So I mentioned that's one form of valuation. Another form of valuation I look at are price multiples, specifically the forward price to earnings, which looks very cheap for Vertiv at 19. Well, I shouldn't say cheap. I shouldn't say very cheap. What I mean is just cheap. It looks undervalued at 19, given the market, given its forecasts, given the operating industry, the growth forecasts. I'm bullish on the need to spend money on these data centers optimized for AI, because I'm seeing the value that AI is adding to enterprises already. And we're still in like the second inning here of the growth of the AI industry overall. So the company looks undervalued when measuring by multiples valuation, and then when measuring by the discounted cash flow valuation, it looks like it's fairly valued. And so overall, putting it together, what do I rate the business? I have a rating system: buy, borderline buy, hold, or sell. I have Vertiv stock rated as a buy, and I updated that recommendation today, March 11th, 2025.